I don't see any particular reason why this structure creates any new or special risks to the country. So I think the structure of NBFCs will continue to be there in the future as well.
So there is nothing today which we feel which NBFCs can't do, or the opportunity is lesser, the opportunity is equally there.
If I look at the current status today, NBFCs probably are as equally well governed and well run as banks are. And in most areas, NBFCs are sort of giving the banks a run for their money. Yes.
In India, the gap is huge.
Yeah.
And that will take maybe few decades to be met by the banks. So I think NBFC will continue to have a big role to play.
NBFCs go to customers and banks expect customers to come to them. I think banks are equally hunting now.
About 10, 15 years back, there was a huge craze for banking license when it was available on a window basis. So when the window was opened, a lot of companies applied for a bank license. However, later on, RBI make it on tap. So you don't have to wait for RBI to come up with a window. You can apply anytime as you want. However, it seems that the euphoria fizzed out following the on-tap approach. One of the reasons why it was so, because RBI came out with norms which says industrial houses cannot apply for bank licenses. Here we have a panel of 5 NBFCs. All these are upper layer NBFCs. And 4 of them are promoted by industrial houses. So they are not eligible for applying for a bank license. At the same time, last 10 years or so, the growth of NBFCs were so robust that it seems that they don't care about any bank license any further, because they have established themselves. They have entered areas where traditional bank has not gone. They have gained market share at times at the cost of banks. So what we will do is that we will give them the opening remarks. I will request them for their opening remarks on this issue, whether a bank license does matter. So may I start with Mr. Sridharan, your opening remarks. Do you think it really matters?
Thank you, Manojit, for having us. If you look at the lending market in India 30 years ago, and you roughly looked at the share of how much banks were doing versus non-banks were doing, versus you look at now, broadly you don't see any change. Non-banks have always been about a quarter of the lending sector in the country. It has gone up and down like in some 5-year cycles. So sometimes it looks like non-banks are gaining share, sometimes it looks like banks are gaining share, etc. But broadly, over a 20-year period, 25-year period, nothing much has changed. It has, non-banks have always been a very significant, though not a dominant player in the lending market. 25% of lending is done by non-banks, 75% of it is done by banks. Is there any particular reason for this to exist? Not really. Like there is, if you think about the sectors, non-bank lending sectors globally, there are always non-bank lending sectors. Lending by banks has always been in that 50 to 70% range in practically every market in the world. The structure of non-banks has been different. India is unique in that we have the structure of NBFCs, which are levered, publicly owned, listed institutions, right, balance sheet institutions. This structure is somewhat unique to India. But this structure has persisted for a very long period of time. I don't see any particular reason why this structure creates any new or special risks to the country. So I think the structure of NBFCs will continue to be there in the future as well. And like in a jungle, the big cats have a particular role to play, the smaller cats have a slightly different role to play, and then there are kind of the insects and rodents who have their own role to play. All animals have a role to play in the jungle. NBFCs have a particular role to play. You are the last mile connector, and you've been able to do it a lot more efficiently than banks have been able to do it, and hence you have been able to build very profitable businesses. It has to be noted that NBFC profitability has consistently been higher than bank profitability. Profitability
important
ratios,
point.
right? So over a long period of time, it has always been the case. If that were, if those facts are to be taken at face value, and then you look at examples of NBFCs that have tried to convert to banks and the pain that they have gone through for multiple years to make that conversion happen, the panelists here would have to have a really strong reason to convert, to take all that pain for that extended period of time. So that reason could be the liability side, and I'm sure the others will have a lot to talk about potential kind of liability stability, which is the one strong reason for wanting to do banks. But otherwise, purely from a profitability, growth, role in the economy perspective, everything is all set. Why change?
So basically, you are saying customer deposit is still the differentiating factor. Apart from that, there is not much of an incentive for an NBFC to become a bank, given the pain one has to take over a shorter or medium term.
Yes.
Okay. Mr. Sabharwal, your initial thoughts.
No, I think both the models are strong. Both the models have delivered. It finally boils down to governance in every institution. And if that is strong, then the entities thrive. If you look at the India opportunity, the opportunity is humongous. There's space for banks to grow. There is space for NBFCs to grow. I don't want to speculate on this because, as you mentioned, there are certain regulations and we work within those regulations. As far as being competitive in the market is, vis-a-vis banks, I think we have the same opportunity of expanding and going to new geographies. We have the same opportunity in creating digital products, investing in technologies. We have the same opportunity in, servicing customers in a similar manner. The norms for large banks as well as upper layer NBFCs in terms of governance are similar. In fact, on risk provisioning, probably India's is better than Iraq in terms of provisioning. So their balance sheets are equally stronger. So there is nothing today which we feel which NBFCs can't do, or the opportunity is lesser. The opportunity is equally there. So at this point of time, I don't think so. There is any reason to debate on this.
Thank you. Mr.
See, when I'm asked this question, I'm reminded of the old proverb, Dilli ka laddu. Jo khaya wo bhi pachta hai, jo nahi khaya wo bhi pachta hai. Right? So, if you look at specifically the NBFC model, because NBFCs generally, there were some deposit-taking NBFCs that exist, but generally since NBFCs had to raise their money from the markets, obviously the money was available at a much higher cost of funds, and obviously that led to a stratification of the segments that NBFCs lend to vis-a-vis the banks lend to. The banks lend to a far more safer set of, quote-unquote, safer set of customers, while NBFCs moved into areas that typically, banks would probably stay away from. So that was the stratification which existed maybe, 3, 4, 5 years back. But what has happened is that with increased digitization in the marketplace, right, and especially with the digital ecosystem developing, first and foremost thing, you have the access to the same credit history of the customer. Through account aggregator, you have access to the same liabilities trade profiles of the customer, which was actually previously a holy grail. Only banks had access to it. And in my experience, that led to 150 to 200 basis points risk cost arbitrage for the banks compared to the NBFCs. Now that also advantage actually also has gone away. And last but not the least, because as Rajiv said, because of the accounting norms of NBFCs, especially, has moved to a far stringent, in their standards. The financial disclosure of the NBFCs are also far more probably, tougher, and the provision requirements are far more tougher. So I would say that if I look at the current status today, NBFCs probably are as equally well governed and well run as banks are. And in most areas, NBFCs are sort of giving the banks a run for their money. Yes, the access to cheap deposits still remains a sort of a desirable thing that most NBFCs would have liked to access to. But apart from that, most of the things are ceteris paribus and on a level playing field. So frankly, the charm of whether you really want to become a bank is probably to a certain extent slightly diluted as of now.
The initial remarks, you were saying that NBFCs played a better role in bringing more people under the formal finance.
Yeah, to a certain extent, NBFCs, if you see traditionally, the last mile lending traditionally has been done by NBFCs, and the capacity of NBFCs to handle that uncertainty in the last mile lending has probably been much, much better than banks for most of the history of Indian financial services.
Right, right. Mr. Revankar, your initial thoughts.
See, basically, when you talked about 15 years back, why NBFCs were thinking of or wanting to become a bank or that kind of a environment or that kind of a thinking was there was mainly because their liability franchise. The NBFCs had a very weak liability franchise or limited liability franchise those days. But over the period, things have changed. Other than the deposit-taking franchise some of the NBFC has, capital market has become very active. Now there is a ECB market also. NBFC are able to go to international market, which was not accessible earlier, not allowed earlier. And bank lending to NBFC also have gone up because of priority sector requirement, or maybe even otherwise banks feel for certain lending, tying up with the NBFC is much better or superior. And also the co-lending now has been increasing. So the liability side is something, there is no limitation now. You can do as much as you want, depending upon the liability franchise and cost of fund you are able to manage. When it comes to asset side, NBFCs have been focusing on unbanked and underbanked. See, here I feel underbanked is the most important. The banks have not been able to service certain segment, certain customers, certain services due to the constraint what they have as a bank. Maybe they're not as nimble-footed or they're not going to the customer. They can't customize the product the way NBFC does. So NBFC has a lot of advantages in this regard. Ability to tailor it to suit to the customer and knowing the customer personally. Many of the NBFCs, if you see, their model is going to the customer. Bank typically is expecting customer to come to the bank.
Correct.
And NBFC typically want to go to the customer. So there's a two different approach. And that makes NBFC to service the customer who are either underbanked or unbanked. So I think if you look at globally as some of the panelists were talking about, even in the US, I was told around 20% of the customers are either unbanked or underbanked. When they have nearly 6,000 banks and so many other institutions, there's still a gap. In India, the gap is huge.
Yeah.
And that will take maybe few decades to be met by the banks. So I think NBFC will continue to have a big role to play. And as of now, we are growing much faster. In the credit disbursement, if you see, NBFCs are growing more than 20%, where banks are growing at around 10 to 12%. So definitely, and in one of the comment, Finance Minister also talked about that NBFC can reach up to 50% of the credit disbursement.
Right.
So that is the expectation because of the inherent the nature of the banking system, which cannot reach to certain segments. So I think that will continue to remain.
I think you have said a very important point at the beginning that raising resources, the options have now broadened up. I will come back to that point a little later, but first initial thoughts from Mr. Rabelo.
Hi, thank you very much, Manojit, and great to be here. We're talking about NBFCs converting to banks, but on a lighter note, there are 4 bankers here who have jumped ship and joined an NBFC. Umesh is the only OG NBFC stalwart here. I won't repeat any points, but I do draw from what the other panelists said, that while there were very specific playbooks for banks and NBFCs, I think that's in some ways now, that arbitrage is not so large anymore. In fact, banks have picked up from NBFC's playbooks. I mean, NBFCs really started vehicle lending. If you look at microfinance lending, if you look at gold lending, I mean, these were all very strong properties of NBFCs, and banks have actually, picked up some good practices of NBFCs. At the same time, while Umesh says NBFCs go to customers and banks expect customers to come to them, I think banks are equally hunting now, right? So we have to be ready that in a country which is largely unserved, there are about 30 crore active or credit served customers in a country where ideally there are 80 crore who need. So the headroom for penetration is large, but both can really penetrate the markets. And also with co-lending coming into being, I think distribution of NBFCs, balance sheet of banks, even that model can help both suppliers really meet the real demand of the unpenetrated credit which is there.
So you're saying that NBFCs are now setting the rules which banks are following, kind of.
In certain categories, there are
Right.
categories like, as I mentioned, in vehicle lending, CV lending, microfinance lending, gold lending. These were never, I think, really pushed. The frontiers of these were pushed by NBFCs. Banks have followed.
Right. The one important point you're also making is that regulatory arbitrage has now is not much. Mr. Sridharan, while the merger between HDFC Bank and HDFC, that was cited as one of the reason that there is not much regulatory arbitrage available today, so let's merge. I mean, that aside, even if the regulatory arbitrage is not there, what are the specific advantages of operating through an NBFC vis-a-vis a bank?
See, the banks have regulatorily, we know the main deltas. Like banks have to keep CRR, banks have to keep SLR. Those regulatory overheads are lower in an NBFC, but banks get cheap and sticky funds, which NBFCs don't have access to. At the very highest level, that's that. There used to be a time, Umesh ji mentioned this, there used to be a time when regulatory oversight of the NBFC sector was also quote-unquote light touch. That is no longer the case, particularly for the kinds of players that you're seeing on the podium here, the upper layer NBFCs. The regulatory oversight is pretty much the same level of intensity as it is for the banks. So there are some regulatory puts and takes in terms of rules of the game. However, a lot of things are very, very similar. And in some cases, the process of harmonization of the two sectors has progressed a little bit more. In some cases, it has progressed a little bit less. And in some cases, banks have been ahead. And in some cases, NBFCs have been ahead. Rajiv's point about ECL and the Ind AS structure, which NBFCs have been doing for years now, and now banks are kind of coming into that regime in a couple of years. That's an example of where NBFCs have been ahead. So there are puts and takes between the two. I don't think it is no longer, I think it's no longer appropriate to think of the two sectors as one being somewhat regulatorily light and the other being regulatorily more intensive or anything like that. They're just two different business models, and they work for different kind of players. And we have made our peace with the NBFC kind of model. And as I said, the sector has been consistently delivering higher levels of profitability than banks. And so there is no particular burning platform reason for any of us to think otherwise.
Right. Mr. Ivankar also pointed out that raising resources is much more available to them. RBI, in fact, last couple of years, emphasizing on the fact that NBFCs cut down their funding from banks. So, Mr. Sabharwal, how do you see this? I mean, many years back, one deputy governor told me that banks are the lifeline for NBFCs. Once they stop funding them, they are gone. So, your thoughts on how the changing funding profile of NBFCs?
No, first of all, I think, India is a large market. Credit is the driver for growth in any economy. And we should approach this, situation in the same manner. I feel both banks and NBFCs are doing a complementary job in terms of ensuring there is more access to finance to the last individual across the country. I think both banks and NBFCs have been working hard towards it. And we are, I think, still not there where every individual who needs finance has easy access. And it is our endeavor through all means to get there. If you look at liabilities per se, obviously, you know, the range of liabilities has changed over a period of time. Today, probably NCDs, private NCDs occupy a much larger share, but we have great support from the banks, and I should thank all the banks in terms of providing support. A good portion of our liabilities does come from banks. Besides this, the large opportunity which is opened up is also in in bonds, dollar bonds, ECBs. That's again a large opportunity is increasingly becoming a larger proportion. For example, just over 10% of our liabilities come from that area, and that's also a pretty large market. Then there is the option of public entities, which again is a large market. So I think diversification of liabilities is crucial. One of the big aspects also is public deposits. If some of the larger better rated NBFCs have access to public deposits, that will also, I would say reduce this linkage and also allow for more, I would say, NBFCs to access some of the other liability sources which today to a large extent go to large NBFCs. So I think the whole idea of diversification of liabilities is a good strategy for everyone in the system, whether it is NBFCs, whether it is banks. Even banks, if you look at it, they've also been looking at how to diversify the source of liabilities, whether it is a small retail depositor, the high net worth customers, or small SMEs or large corporates. So I think everybody is in the situation where they want to diversify their sources.
In fact, deposit mobilization is one of the biggest challenge banks are facing, because alternative opportunities have really increased. In fact, the bankers present in the morning, they alluded to the fact. But I was coming to that point that now, do you think that RBI has not allowed new NBFCs in the last 10 years or 15 years to accept public deposits? Do you think a review of the policy is required, as Mr. Sabharwal is also hinting at?
Yeah, I think access to public deposits obviously will be a welcome thing for NBFCs, but as you said, RBI in the recent past has not given any fresh deposit taking license to any NBFCs. Those that had almost 15, 20 years back continue with that. Now, obviously, but again, we obviously, I cannot comment on what are the thought processes in RBI's mind. But definitely, probably, if a start can be made, especially with the upper layer NBFCs, right, obviously with some thresholds, right, then it can be another source of low-cost resource mobilization that opens up NBFCs. And, given the fact that the credit demand in the country and the credit push that, again, between the government and the RBI, that we are all getting signals of, that will get amplified because, as Rajiv said, a large proportion of our lending still comes from the banks. For example,
Right.
for our organization, 50% of our, sort of resource mobilization, deposit mobilization, liabilities mobilization still comes from banks, right? And, about a couple of years back, when the risk weights were raised for the banks on lending to NBFCs, all of us felt the squeeze, right? So obviously access to public deposits will give us another low-cost deposit source, liability source, and obviously it will be very, very welcome if RBI could reconsider that, especially for the upper layer NBFCs.
There is an
If I may add one
NBFC
point,
yeah.
sorry, if I may jump in, there is one, we keep having this conversation about deposits, right? And it has been what, 12 years since RBI last gave a deposit. All of us as 97, Rajiv tells me. So it's like 27 years, whatever it is. Some ridiculously long period of time since they've not given us. But we keep talking about deposits and deposit licenses and so on. All of us as CEOs of our companies have all got a limited time span in life. And we have to make choices and decisions within that. I'm reminded of an old famous शेर कि उम्रे दराज मांग कर लाए थे 4 दिन, 2 आरजू में कट गए, 2 इंतजार में. अब कितना इंतजार करेंगे भाई, हो गया, अब आगे का सोचो.
There is an SRO now, RBI recognized SRO. So do you think you can revive that?
Mr. Umeshji is here.
Yes,
Before
yes.
you come in, I just noticed, I don't know whether this happened by design, the 2 deposit-taking NBFCs are sitting here.
So, Mr. Ivankar, will you take it up? The SRO will take it up with RBI once again, given that the regulatory environment has turned a bit conducive. Don't you think so?
See, whenever we discuss with regulator this as a point, regulator normally, they deflect on this and they try to avoid that discussion. So we can always say that the upper layer NBFCs, which has a strong support from the institutions or who has long-standing record, can be allowed, is something which we keep asking the RBI. Alternatively, we should also, I feel, aggressively go into the capital market, where the bond market is very shallow in India. So many of the well-educated or who understands the financial instruments, they would prefer to invest in corporate bonds. So I think we should do both together.
Right.
We should also try to see how to deepen the capital market, retail, so that many of the retail investors, can participate in the bond. So I think we need to do both. We can't be just depending upon one. So this is something which, as a SRO or as the industry body, I did also met the SEBI chairman and spoke about it. So that there is some kind of awareness getting created that investing in the corporate bond market is as good as investing in a deposit or in mutual fund. Because the way mutual fund industry have grown in the last 10 years or 5 years, I think similarly some effort can be done in building that corporate bond market.
So out of the 15 upper layer NBFCs, how many at present has access to public deposits?
If I remember, 4. Bajaj, V2, and one more upper layer is Sundaram.
Oh, only 4. Only 4. Okay, now I will come to the difficult part, asset quality issues that some of the NBFCs are facing, particularly unsecured lending. So, Mr. Rebello, if you can throw some light on how are NBFCs tackling the stress in unsecured lending?
Maybe not the right question for me, because under 3% of my portfolio is in unsecured. But I think, see, as NBFCs, we, because of our cost of funds and, versus the banks, so we will always be in businesses where, we price higher, and hence we do factor that into our business model. The credit risk and the credit cost will be higher. I think the way to look at it is, we can't look at 1 year's credit cost, or we have to look at cross-cycle ROAs. Right? And many of the businesses that we NBFCs are in are going to be more cyclical than where banks play a large role, right? So as long as you know that you can create buffers in between, you can, when the times are good, you kind of adequately, create those buffers, so that across cycle you're able to, keep the profitability in a range-bound manner. I think that's the way in which we should look at it. But again, I'm not really, as I said, we are under 3% of unsecured. I know there is certain stress in some segments, but I'm sure, like everything will pass, this will also pass.
Right. Mr. Roy, you have a significant portfolio of microfinance. How are you handling the stress there?
See, microfinance, again, microfinance is really the most riskiest unsecured lending that you can do. And obviously the industry went through an asset quality crisis last year. Fortunately for us, probably, especially I can speak of L&T Finance, we have been the least impacted in it. Our risk costs and credit losses were the lowest among all the microfinance heavy lenders. And I can safely say now that the industry is probably in the last stretches of the asset quality issue that it saw that lingering in for the last 15 months
Right.
so. I do believe that another 2 to 3 months would be the long tail of this, and Q4 of this financial will be the period of normalization when normal sort of metrics will set in. Obviously, as during this process, as it happens, what happened is that the industry grew too fast. Post-COVID, between 22 to 23, the disbursements to the microfinance industry, by the microfinance industry to the target segment went up by 40 to 45%. Now that was the growth rates, average growth rate. Now if you have that amount of money pumped in, right, into a sort of a sensitive customer segment, then obviously leverage is bound to increase, and once leverage increases, obviously, things will go bad after, sideways after some time. And that's exactly what happened. Organizations that kept the leverage in mind, organizations that were more prudent in lending and maintained their association norms, right, and the lending norms judiciously, were the least impacted out of it. But yes, the industry deleveraged quite a bit from about peak of 4,20,000 crores of book size. We are now almost lost about 1 lakh crore of book size in the last 15 months. So I would say it has been a painful deleveraging for the industry, but I would also sort of give compliments to the industry that MFIN did a fabulous job in sort of setting the guardrails, and actually proves that an SRO can step in time of crisis and probably regulate the industry quite well. So MFIN has done that job very well, and I do believe that sooner or later the industry, maybe within the next 3 or 6 months, the industry will resume its growth path.
Right. So Q4, you see when it's bottom out. Right. Mr. Sabharwal, apart from MFI, are you worried about the stress in other unsecured loans?
So actually, I'll talk about what I felt happened in the industry, and then, what we have experienced. I think what happened is, and this is what typically happens, leave aside 10% of the people who may be a little more aggressive, but 90% of the lenders always are prudent while they give out money. But what happened in the unsecured market is when they gave out money, they felt they have evaluated the leverage and it is okay. But after they gave out the loan, within the next 3 months, there were 3 more lenders who also gave out loans to this. So I think first thing, structurally what the regulator has done, which is very good, is collapse the time in which you have to update the bureau records. That became 15 days, and now it's going to become a week. So I think that is a very, very, and I should really compliment RBI for being, taking this step. It means that a lot of systems will change, but I think in the long run, this will be very, very significantly useful. As far as we at Tata Capital are concerned, I think we have seen the worst of credit costs. Our Q2 credit costs were 30 basis points lower than Q1 credit costs. So we started taking, action on whenever we see any stress in any segment, whether it is, whether we see it or not, if the market is seeing it, we do believe that it can come to us. So it is better to become conservative at that point of time. And we became conservative about 15 to 18 months back. And what we have seen in Q2 is credit costs significantly coming down compared to Q1 in all segments, whether it is unsecured or MFI or anything.
So you're saying worst is over for you. Yeah. Mr. Sridharan, what is the USP for NBFCs from a customer point of view, since products are largely same?
The retail segment in India forever has been in a state where you can say the demand for credit has been higher than supply. That has generally been the case. The question is, how do you reach the demand? How do you assess credit quality of that, and how do you price? That has not been possible for large banking institutions. What NBFCs have cracked is the distribution model, the underwriting model and the customer segmentation. And you have innovated on products and continuously created new product categories. Rahul mentioned this a little while ago, but it's worth reiterating. Most of the product innovation in India in lending over the last 40 years has happened from NBFCs. It has eventually become banking product. Home loans was originally an NBFC product, became a banking product. Auto loans was originally an NBFC product, eventually became a banking product. Same with MFI, same with gold. Every product category, NBFCs have innovated and banks have come in when it has reached a particular scale and business model has stabilized. And banks have taken it to the next level, right? It's not that like banks have not added value, they've taken it to the next level. NBFC's role remains the same, which is continue to innovate, try and come up with new product categories, and some of them might not work. BNPL, NBFCs innovated, did not work, right? So you will innovate, some things might just not work. But it's the job of NBFCs to be at that leading edge of product innovation, customer segment needs, etc., and try and figure out where we can actually come up with new products, structures, customer segments, and create something which can actually be scalable for banks to take on later.
Right. We are completely run out of time. I will give the last word to Mr. Revankar, USP of NBFCs.
I think NBFCs are designed in the way that you connect with the customer directly, because you know the business of the customer. And if you look at the vehicle lending, gold finance, housing loan, all those things, all the innovation happened at NBFC level because they try to innovate, customize, and give the product suitable to the customer. So banks would have picked up something out of it, but I don't think banks will pick up everything what NBFC has been doing. So NBFC will have that USP of being a different niche player, build experience, have a deep knowledge, and that kind of a reach to the customer. So that will continue to remain with NBFC.
Right.